Hey, good morning, options traders, and happy hump day, everyone. And this video is in response to a question that we got from one of our traders last week asking about moving averages. And his question was, why should you use different time frames? And what he was talking about is why might we switch from, let's say, a daily chart to a weekly or to a monthly? Those are the time frames. So it's a good question, and unfortunately a lot of times traders don't do that. They stick with one time frame and a lot of times even just one moving average. So let's take a little deeper dive and find out why should you use different time frames for your moving averages. Well, let's first answer a simpler question: why use moving averages at all? Well, the basic reason is to smooth out your data. Whatever it is you're looking at, in our cases it's usually stock prices, but whatever the data happen to be, it smooths them out. Instead of getting all of these sawtooth patterns and zigs and zags, we tend to get a smoother line. And it just makes it a lot easier to figure out if the overall trend is up, down, or sideways. You can also use them in a different way, is to determine if current prices are above or below average. So, all things being equal, sure, we'd like to see that prices are above average, assuming that you are bullish. If you've got a short position, yes, we'd like to see that the prices are falling below average, and this is a very good way to determine it. However, changing to different time frames will give you a different perspective. What else? Why else would we use moving averages? Well, we can find support and resistance levels for trending prices. If you have a stock price that's going sideways, we would usually use just flatline support and resistance. But if you have a stock that is trending, whether making a really rapid rise up or taking a really rapid fall down, we will usually look towards moving averages. Now, moving averages can also allow traders to see changes in trends. Where are these turning points? So those are some of the basic reasons for using moving averages. But the big question that we're trying to figure out here is, why should we use different time frames? Or at least, why should we consider flipping over from one time frame to another? Well, again, traders use various moving averages. You'll see some people that use a 9-period moving average or a 12 or a 20 and things like that. I've talked about this in a previous video about the 5 key major moving averages, and those are going to be the 50, 100, 200, 500, and 1,000 period moving averages. So by period, I mean that if you're in a daily chart where each candle represents one day, the 50-period moving average is looking back 50 candles. The 100-day is looking back 100 candles or 100 days. If we were in a weekly chart, then the 50-period moving average would be looking back 50 weeks, almost a full year. So these are the various lengths, or what we might call the aggregation periods of a chart. But again, for this video, it's more about the time. Are these daily charts, weekly, monthly? Those are probably the 3 most common. We also have intraday, where we can see that each candle might represent a 5-minute block of time. So again, the question that we're trying to figure out here is, why use different time frames? Well, the very basic reason is to get different perspectives. And you'd be surprised by flipping over to different time frames that you can get very different perspectives, and they can certainly help you to make better decisions. So for instance, trends can increase because trends are improving. That's one reason for the increase. But they can also do it because the old data are simply falling off. So that's why I have the word increase in quotes there. Just because we see the moving average rising doesn't necessarily mean that the current prices are doing all that much better. It could be that the bad prices are just simply falling off. But when you switch to different time frames, you will again get different views. So for a simple example, let's say that we're back in school and these are test scores. So we can see that we really bombed the first 2 tests here with a 60 and a 62, but then we started to improve. 85, 98, 96, 94, 92. So if we did a 5-period moving average, or a 5 test score moving average, and looked at the first 5, the average is 80.2. But if we move that average up into this range, it rises to 93. So you might say, well, in order to go from 80.2 to 93, things are improving. Well, is that really true? Take a look. We went 98, 96, 94, 92. things are actually sloping downward a little bit. The main reason for going from roughly 80 to 93 is that we dropped off this 60 and 62. We're just looking at the average of these 5. So this is why you can see that things might appear to be improving, prices, because this average is moving up, but it's not necessarily because the prices are doing all that much better. It's just because you're dropping off old data. And of course, we could get a combination of the two. So what's really a basic use of a moving average? Well, probably the simplest is to determine if current prices are performing better than the past. Are we above average or below? And it's very simple to do by looking at a moving average. That's the whole definition. That's how the calculation is coming about. And we'll look at some examples in just a moment. But again, different views will give you different answers. And that's why it's so important to flip to different views. So for some examples, let's go over to the E-Trade platform and take a look. Okay, so now we're into the E-Trade platform. I've got the S&P 500, the Spiders ETF, and take a look at the prices. We see a lot of sawtooth, this zigs and zags in the stock prices, but take a look at the moving averages below. In red is the 50 period. This is a daily price chart, so this is the 50-day moving average in red. And notice that it's fairly straight. See, it takes out a lot of the wiggles and the zigs and zags in the data, and we can quickly see that this is a very strong uptrend. If we go to the 100 in orange, even straighter. 200 in yellow, definitely very straight. 500 here in green, very, very straight and smooth. So as I've talked about in other videos, whenever you see the moving averages fanning out like this, running roughly parallel, that's a real good sign that we are in a very well-defined uptrend. Quarter after quarter, we're seeing great earnings from all of these companies. So that's a very quick way and a quick use of moving averages. But let's drop back here to coronavirus. So again, this is a daily chart, and notice that the markets were cruising along quite nicely. Moving average here in red, that's the 50-day, is moving up nicely, and really within one candle broke right below it. So in one day, we went below the average price over the last 50 days. How can I see that? Well, remember, this point right here on this red line, right there on that red 50-day moving average, is the average price over the last 50 days. And yet, look at where the prices were. See, they were always well above this red line. So prices are above average. But in one day, this candle fell below average. That's a big move. And that certainly gave us some good insights into the severity of the news that was coming out. But then we quickly fell through the 100, the 200, the 500 down here in green, and we just went off a cliff. At least that's the way one perspective looks. All right, so here's this big dramatic fall. We see that these prices down here got stretched away quite a bit from this moving average. And so we should expect some mean reversion to come in sometime soon. So that's why a lot of traders were saying that we were expecting a very sharp snapback, one of these V bottoms. Once we got that, what can we also say here? Well, at this point, we were above the average price because the candles broke above the red. But what's causing this? Well, a nice little way we can look is to come back here, click on this pencil, and from this drop-down menu, you want to choose this one that says Measure. And it will measure the number of candles from a specific point. So I'm going to left mouse click on this first candle that broke above the 50 and drag back to this one right there. And if you look right up here, it shows that those are 24 bars. So that's 21% below. So what does that tell you? Well, it tells you that as we went into this rapid rise through here and we saw this very sharp turn in the moving average, it wasn't so much that the prices were doing all that much better through here than back here. It's because these data were dropping off. See, it's kind of a double whammy. We were getting good prices on this side, but we were also losing the old data. And so sometimes when you have very sharp rises and falls, that can get a little difficult to interpret. So let's drop down to a 100-day moving average in orange. Fairly straight, little dip in here, but a little smoother. But look at the yellow in 200, just flat. Didn't really have a lot of effect. And that should tell you that, hey, yes, it feels like we're going off a cliff, But if we're looking at over the past 200 days, the prices are still just steadily moving higher. Yes, we were well above where the 200-day moving average was here, and then we quickly went below it, but we also quickly came right back above it within a period of about 3 months or so. So that can give you a very different interpretation of what was actually happening. But now watch what happens if we flip over to a weekly chart. So to do that in E-Trade, come up here, and right there where it says daily, click and drop down here to weekly, left mouse click, and what do we see now? Now look at this. Remember, this is no longer a 50-day moving average, it's a 50-period moving average, and because we're in a weekly chart, each candle is a week. So these prices here were doing much better than over the past 50 weeks on average. This is the average price over the past 50 weeks, right on this red line. But again, within 1 week, we quickly broke that. But really, if you look at the prices, here's the 50 period, 50-week moving average in red. Here's the orange, which is the 100, just moving steadily up. So that should really give you a different insight that this is just a very quick blip on the map. And if we switch over to a monthly candle, look at that, can hardly even detect it. So if we zoom out quite a ways, you can see very steadily moving upward averages. So that would be a way to kind of help to keep your bearings and your sanity and say, yes, it is a sharp drop, but it's only a period of about 50 or 60 days. Let's give it some time here. Let's maybe not make some rash decisions. Let's go back to the daily. And so now, again, we can see how quickly we went off this cliff. Well, how many days was this? Let's go back to measure. So if we click from the very bottom of coronavirus to the point where it first broke, right there, and if we come back up, it tells us that that is right there about 21 bars, or only about 21 days. So it's about half of the moving average, right? It's a 50-day moving average. This is only 21 days. It's not really all that long, especially for stock market standards. So on this date, when you're watching this rapid fall, take a look at the 100 and the 200 and notice that they were still steadily rising, even though the 50 rapidly fell through. Also, once you see that it starts to curl around, this 50-day moving average right here, we know that it's partly from this rise through here, but it's also because we're starting to lose some of these falling candles. And we know that as the moving average continues to march on, it's dropping off these candles and picking these up, and we're going to see a very big rapid acceleration. And once it goes through, in this case, the 500, and then the 100, and then the 200 here in yellow, that's probably when everybody else is going to start piling in. These are all major moving crossovers showing us that the prices, for instance, right here, at this moment, we're doing far better than they were over the past 50 days, the past 100 days, and the past 200 days. So yes, traders are watching that, and that's what's causing people to react. Now, of course, how we respond to that and put trades on and hedge, roll, morph, whether it should be a positive gamma position, negative gamma position, is a whole different story. But for right now, I just wanted to at least give you some insights into why we might use different moving averages, but more importantly, why you might want to switch to different time frames. And so, for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.